Good morning, everybody. Welcome to the Avondale Mergers and Acquisitions Post-COVID-19 webinar. My name is Kevin Uphill, and I'm the chairman of Avondale Corporate. So I'll be talking this morning, but I'll also be hosting to discuss how we think mergers and acquisitions will be impacted as a result of the coronavirus 19 environment. And within that backdrop, I hope everybody's well. We've got about 50 minutes today. We will be taking questions as we go. Our last webinar a couple of weeks ago on employee ownership trust, we had so many questions in, we actually had to fall to a frequently asked questions session. So we emailed that out. That either mean we did a very good job or we did a very bad job. We're still trying to work that out. So hopefully we'll get to your questions as they come in. Now today we've joined by two panelists. I've got Tim Hardman, my co-director, and he will be talking a bit about valuations and how we see those and deal structures. And Emma Cameron from VBW Lawyers talking about where we think legal trends will sit from a perspective again of post-COVID. Both of them very experienced backdrop, and I'll be asking them some questions as well. So what do we see happening? Well, I am denied about including this slide, but I thought we ought to. Clearly, coronavirus is bad news, and it's certainly not been fun. But what we can see is it is contributing to what we've seen for some time over the last 10 years. And that is ultimately that economic growth in the Western economies has been much slower in the last 10 years than it has in the previous 50, 60 years. And a lot of that, in my opinion, is also to do with population growth. If you look at the graph of population growth over the last 60, 70 years, we've gone from 2 billion to 7.7 billion. That population growth is slowing. We now have an aging population. And arguably, COVID could be arguably seen to be part of that. There's been a lot of talks by economists around, are we going to see a V shape or is it going to be a U shape? My bet is a slight W shape, actually. I think as we realise the impact of Brexit, which is still not agreed in terms of trade terms, and also the knock-on effect of certain sectors of the economy being locked down, from travel to leisure, and how that ultimately impacts on our economies, I think we are in for a fairly long decline period. Having said that, economies always recover, and I think government stimulus is obviously going to help that. And we see that with record low interest rates, there is real scope for governments to borrow more money than they've ever done before to pump back into the economy. And actually, we've got an infrastructure project at the moment we're working on, and we've got a lot of interest in that because people are aware of that potential opportunity. So to a certain extent, we see that there has always been slow growth for the last 10 years. That actually drives mergers and acquisitions. If you think about it, in slow growth environments, too many companies doing the same thing. Therefore, there's only one choice, which is they compete on margin, prices reduce, and productivity fails. Whereas M&A is all about bringing companies together in order to push more scale and margin. And we call it the four corners of M&A, economies of scale, cost reduction being one driver. The other driver, synergies, the ability to cross-sell products from one party to another. And then, of course, the shareholder value driver, which is also a critical part of mergers and acquisitions. And we bring that together within the context of, the fourth driver is positive disruption, which, if you like, is the sum of those four elements. And actually, post-COVID-19, particularly with a recession looming as we have, we don't see those four trends going away. And the fourth, within positive disruption, ultimately is technology is disrupting everything. So there's a lot of change out there, and we need to understand how that is impacting on business models and will also impact on mergers and acquisitions. Now, we're with our proximity to London, also very well placed to access the capital markets. Private equity, we think, are going to have a really key role Yes, trade deals are important, and you can maximise value through doing those. But private equity is also going to become increasingly important. There's 2.3 trillion pounds worth of capital looking for investment in private companies, and the reason for that is that there's a limited yield elsewhere, and that is forcing people to look for higher risk areas. And the emerging mid-markets, companies with between say 300k and 5 million profit are really important in terms of generating yield. If you can grow those companies significantly, that not only contributes to the economy but also returns to investors. So we think that access to capital will be a really key part of, if you like, the recovery equation. It's very early to have this event. Lockdown's only just starting to ease off, but we also think there's a bit of a factory reset that's going on. And by factory reset, I mean it's been enforced on us, hasn't it? COVID-19, none of us chose it. The lockdown's been interesting. We've been blessed in the UK with great weather, but a lot of time to reflect. And we believe that owner managers in particular are going to be more open to investment, mergers and or acquisitions, and the logic behind that is, to a certain extent, they have been ambivalent about doing deals. Their companies have been working, they've been getting a good yield. What do you do with the money? But I think COVID-19 will show that their business models are not infallible, and I think that's quite an important point. I think people will be more open to conversations, and for those of you who are professionals in M&A, that of course means more opportunity, because you can have more conversations with people, and we think that's going to be a key part of the post-COVID environment. Ultimately, whilst I showed a horrendous graph on UK GDP and Western markets GDP, markets bounce. In the last 30 years, every single recession within 1 year, markets had gained 10% from their low point. So markets bounce. Civilization is not going away. There's 7.7 billion of us, and there's still going to be hugely continued economic activity. I think it's really important to recognise that the bad news that we see day in, day out on COVID is part of the sort of negativity that the media have to put on us, because that's what sells newspapers. It's not all bad news, and there are some actually really great success stories going on, and certainly we're already seeing deals starting to be announced, and at some quite strong valuations. Part of that is, again, back to this super abundant capital. Emerging mid-market companies can create a fantastic yield, and that money is looking for a home, looking for those yields. So we think that, and certainly our phones are very busy in terms of trade buyers and private equity. We think ultimately, however, deals are going to be driven far more around the business model. Historically, mergers and acquisitions has had a bit of a focus around scale only, but increasingly, with business models being disrupted and at a far faster rate, our management consultancy team did some analysis. Business models are changing every 10 years, whereas 25, 30 years ago, it was every 20 years. So business model life cycles have reduced by half in the last 30 years. So those models need to be more dynamic. Organic growth is one way to change models, but acquisitions is faster, and with low interest rates, it's highly affordable in terms of looking at acquisitions. So we see that M&A is going to be driven around ideas and the business model, and people looking, if you remember those four corners I talked about: synergy, shareholder value, economies of scale, but also the bottom one, positive disruption. We think that ideas and the creativity around that is going to become even more important. So perhaps less direct trade deals, more transactions which are complementary and off-piece, picking up on those synergies, but also more private equity investment, bringing together companies to create more productivity and stronger businesses. So the market isn't dynamic at the moment. It's starting to build up. We're seeing that. And we think the underlying fundamentals are very positive for a dynamic M&A market. We have no choice. We have to change the business model to recognise the cross-sector threats and the technology threats that every sector is seeing. Obviously, within the bounds of a very big economic shock, we don't know how big that is going to be. Is it a 10, 15% drop in GDP? We don't know. Then there are also going to be distressed deals. And within that context, there are going to be value plays. And I'll be talking to Tim a little bit about that in terms of how we might take better advantage of those opportunities. One of our key areas is that we're going to have to keep things more simple. Mergers and acquisitions do tend to get quite complicated. And if you're doing distressed deals, they need to be fast. So how do we manage risk, yet be more agile? Mergers, we've already talked about. We see people are going to be consolidating more. But the old rule of thumb is it's not just about money. Most deals fail around culture. So that remains an important part, even if you're moving more quickly because of the recessionary pressures. Do not forget, deals are about people, and how people work together is the number one dynamic beyond the value. We think there's going to be some increasing debt to equity swaps, certainly in the UK with the Sybil loan schemes, for example. They're going to put pressure on cash flow. We're not sure how people will view those from a debt-free, cash-free point of view, and we need to consider that going forward. But I think there will be some people who take on significant debt and won't be in a position to pay it off, or want to, because the duration will take too long, and their market is too dynamic, and they will be looking to take investment in an equity to offset that debt. We have seen that some trade buyers are distracted, and understandably, we're working with one corporate PLC with 5,000 people. Been quite interesting seeing some of the changes they've had to make. But ultimately, they also are still going to be forced to look at M&A where their business model is under threat. And that comes back to, we think that business models are more dynamic, and within this context of slow growth environment, that forces people to look at their strategy around how they become better than the competition on the business model. And within that, strategic acquisitions becomes a central point. Now, we've been seeing a trend for some time around trade buyers not always instantly integrating businesses, and we think that will continue. Now, the traditional viewpoint is you buy the company, you bolt it on, you merge it, you get those economies of scale. But as we've discussed, actually positive disruption is more important. That is buying companies with teams that you don't have access to, intellectual property that you don't have access to, and new markets that you don't have access to. If you think about it, integrating a company is a big change management team, big change management ask. So buying a company, integrating it, all within the post-COVID backdrop, as well as the significant technology change backdrops and faster changing business model, that's actually 4 change management programs. COVID, lockdown changes, business model changes through technology, and an M&A integration. And so we think a lot more trade buyers will be buying companies and holding harmless and integrating more slowly. And we think that's an interesting trend. And will impact on deal structures for some sellers. So there is a lot of opportunity out there for acquisitions, and trade buyers, I think, are very aware of that, to the point where having conversations with people like ourselves in terms of how do you find the right opportunities. Our own sort of house style on it, yes, we have sellers, we act for sellers, but actually we think far too many acquisition briefs are not properly targeted. And fundamentally, it sits around leaders who've got access to cash, but they haven't thought long and hard enough about where their business model is heading and what their future customer is likely to want. And so we start our sort of acquisition mandates, if you like, with who are you really and where can you be better, rather than, yes, you know, let's go out and look for what's immediately asked. And we think that's really important, because ultimately, if you remember earlier, I said I think people will be more open, and there's going to be more scope for better conversations as a result of COVID-19. You need to be talking to the right people. And if you're trying to talk to 200 people, you cannot build relationships. Whereas if you get really clear on your future market dynamics, what your future customer is going to want, and how you place your business ahead of those market drivers, then you can see more clearly who you need to buy, and then go out and have the bespoke ongoing conversation with them on a relationship basis. So we think that in a very pressured environment, whilst there's opportunity for trade buyers to acquire, we think they do need to get more focused in order to sort of laser in on the conversations. So I'm going to be talking in a second about valuation, but I'm going to be inviting Tim and Emma in the conversation to give us some of their opinions as well. We've had a couple of questions in already, so please do fire more questions in. We'll try and get to those within the panelist questions as well. But the key point in terms of predictions are, we think that good sectors will be professional services, with a global scope, because they're highly scalable and they take less capex. Technology, of course, we've all seen that virtualization and the digital trend will continue, and we think there's going to be a lot of transactions in that space, particularly as people look at the connected world and how to join the dots up within the connected world apps. Of course, healthcare is going to be positive out of this. Infrastructure spend, utilities, we've talked about that. Potentially a good area. And then long term, perhaps UK manufacture, as people adjust their supply chains to look at the global risk in terms of the economy. We think there are going to be more partial exits rather than 100% exits as well, as owners look to take investment in, but also go on a journey with bigger trade buyers. And that's partly because owning companies is a good yield. So whilst you might be looking at an exit from an age or life cycle perspective, continuing to own a slice of the business could be important. We also think that employee ownership trust will pick up where MBOs may fade. Management buyouts, leverage buyouts, I think are going to be quite challenging as we go forward. Again, within the backdrop, we've got the civil loans to pay back first. And then doing a management buyout on top of that is going to be increasingly pressured. The advantage of employee ownership is that vendor loans are promises to pay, so they can be much softer, and they give you a 5-6% yield. So we think that they will pick up on the management buyout. Also, within that context, they can be vendor driven rather than employee driven. And if you look at the risk backdrop, that's going to be quite encouraging for employees, whereas management may not sign up to personal guarantees, etc., within the scope of it. So we need to look at valuations and how they will occur. And look, you know, this is conjecture. We don't fully know yet, but we should look at some of the traditional sort of market fundamentals. Some of you may have seen that highly humorous coffee mug, EBITDA, earnings before interest, tax, depreciation, amortization, and now COVID. We're absolutely clear that both trade and private equity buyers are going to be happy to model past COVID. We're calling that the COVID bounce model. But of course, the key is that they've got to be done against the empirical data of what's actually happening out there. So people are going to have to take a view on those models, but at the same time, they need, from a corporate governance point of view, to manage risk. So we need to have good data to input into those models. So I think that deals are more likely to be occurring towards the back end of the year as people can see the COVID impact and where that's impacting from the model point of view. And obviously there is also going to be an increasing trend to look at deal structure to hedge around that model, and we need to understand the impacts of that. So valuations, typically in emerging mid-markets, valuations run between 4 and 12, 13. We've seen some deals off the scale at 15, at the higher end in the sort of 5 to 10 million pound EBITDA ratio. And there is an argument that valuations will in fact go up for what we call survivor companies. So survivor companies are those who have got through the COVID-19, they're in good shape. Yes, they may have had a hit, but they've worked hard on being lean through the environment. They're waking up hard and fast. And to a certain extent, those opportunities will be rarer. And because people are going to value quality in a volatile market, actually there'll be more interest in them, which may actually drive asset prices up. Now, I'm going to leave this slide on, but I'm going to introduce Tim and Emma. Tim, Emma, if you can unmute and join us as panelists, that would be very helpful. We've already had some questions come in, so we'll tackle those, and then we'll move to Emma first on some of the legal elements. But Emma, we've had a question which is around shareholder compliance. So welcome to the webinar. The question is, COVID increases risk, and yet shareholder compliance has already slowed deals. Will this add to an already complex environment, and can it be insured? Emma.
Okay. Yes, hopefully you can hear me. I don't think my video is on, Kevin, so...
Okay, we'll see if we can do that. You keep talking and I'll see if I can sort that.
Yeah, it says... So, I mean, I think in general, it's likely that deals... we're trying to get deals through. Obviously, some of the deals are at the moment in a sort of distressed situation, so we are trying to get them through. But the person asking the question is absolutely right. There's additional compliance issues at the moment. I'm not quite sure exactly which ones the question is alluding to, but certainly it is difficult at the moment to get things through the way you want to, because there's issues with just the practicalities of people signing documents and making sure the governance requirements for people attending meetings and so on are met. For most circumstances, there are ways around all those issues, but it's just working through them and making sure, for example, that if you're having virtual shareholder meetings, that absolutely all the requirements of the articles are followed precisely for those types of things. So yes, I can see that it will slow things down, but with a bit of an imagination and careful analysis, we're finding that usually we can find a way through those issues.
That's great, Emma. I think we should have a question also for Tim in a second. Emma, I can't turn your video on. You might have to do it your end, so just give it a go. If you can't, don't worry.
Yeah.
Tim, I talked about deal structures and particularly EBITDA. I mean, we've got a webinar coming up on valuation, so we'll go in more depth on that one and on the specifics of it. But yeah, do you have any examples yet of a COVID bounce model, or have you got any views on exactly how that will sit?
I'm sorry, Kevin, just before I start, I've tried to turn my video on. Either it can't, it's obviously been blocked at your end, so I don't think there's anything Emma and I can actually do about this at the moment.
You'll have to put up with me, guys, sorry.
Yep. No, I think it's too early for specific examples. I mean, I think we are still in the midst of change. I think we are going to see, some effect on valuations. I think you're going to see some statistical changes, but it'll be statistical averages. What I do also believe will happen is actually valuations on a deal by deal basis will remain relatively consistent. Now that may sound slightly confusing. In one hand, I'm talking about changes to the statistics, and then I'm talking about deal by deal valuations remaining the same, and that's really down to how statistics are gathered. When information about multiples paid is published, it's usually based on last full year's earnings. But as I'm sure Emma will back up, when you're in a mix of a deal, any buyer is looking at what's happening in the here and now. Not some historical accounts. And therefore, if you do have a drop in performance, then that is going to affect the statistical average. However, the multiple paid is probably consistent with how the business is performing at a given point in time. So I'm expecting that. But I also do think supply and demand will keep valuations buoyant. I think we will have less buyers in the market. I think your point, Kevin, that certain buyers will be worrying about their own issues and firefighting, dealing with their own restructuring and remodeling and things like that for a period of time. But there's no doubt there are still buyers out there. You mentioned 2.3 trillion of dry powder in the private equity market. I should point out that's Europe alone. That's not global. I don't have the statistics for the US, China, but I mean, it's astonishing sums of money, all looking for a home. So whilst I do expect to see a reduction in the number of buyers, I think the reduction in number of sellers is going to be far, far higher, in which case supply and demand will simply, maintain values, possibly even in certain circumstances drive value. But it is going to be down to how the individual business in question is performing, how it has dealt with the COVID crisis, was it affected, and how it bounced back. I think I would throw in a cautionary note though. If I were acting on buy side and a business were performing very well as a result of COVID, and if I take a slightly obvious and maybe silly example, I'm sure there are manufacturers and sellers of hand sanitizer who are doing extremely well at the moment. But I would be looking at their margin today compared with their margin pre-COVID-19, because I think, whilst they might be making hay while the sun shines, and I suspect if we stick with our hand sanitizer example, more people will continue using hand sanitizer post-COVID than did pre-COVID. Nevertheless, there may be an uplift in margin at the moment because of supply and demand. That will find its natural balance post-COVID. So I would be looking at that and factoring that into my calculations as a buyer.
Okay, that's very helpful, Tim. And sort of Emma, just sort of coming back to the sort of legal side of it, we've discussed that we think deal structures may alter slightly, and particularly around the post-COVID bounce model, if you like, and that's simply because there's less cash flow visibility. People are likely to put more earn-out structures in place, and vendors are probably likely to seek them because you don't want to do a deal based on 2020 numbers. You want to do it based on 2021 numbers. What do you see as being the key ways to legally protect those? Because earn-outs, have always been with their risks. So how are lawyers going to look at that? And are there any changes that COVID's going to impact on with those sort of earn-out type structures or deal structures?
Yeah, I think you're right. We're already seeing some of the heads of terms that we've had come in that we're sort of going back to the sort of scenario where we had after the situation 2008, 2009, where we had years and years of deals with deferred consideration, earn-out, and then more recently we had a few years where we had quite a lot of deals where we had nothing like that and everything was paid up front. So we now seem to be reverting back, as you say, for sort of obvious reasons, to a more sort of secure structure whereby the buyer obviously doesn't want to hand over all the money at the moment, and that makes sense. And for the seller too, it means that at least they can sort of argue that overall they should get a bit more, and hopefully the value of the business will go back up once we're through the worst of the COVID situation. As regards what this, well, from the seller's perspective, first of all, to protect itself, one of the key things is to do its reverse due diligence on the buyer, even before you get into the real legal drafting, because the buyer might not be immune from COVID issues, so the seller needs to be comfortable that the buyer is actually going to be good for the money going down the line. And then you're thinking about ways to protect that, whether or not the buyer can give some sort of security. So, for example, if the buyer is using a special purpose vehicle to make the acquisition, the seller would be wanting a guarantee from the parent company. They're thinking about possibly debentures and charges over the company's assets, some way that the seller will have comfort. The issue we have at the moment, certainly in the head of terms that we have seen, the sellers haven't necessarily been in a particularly strong bargaining position. So it's not the case at the moment, and maybe that will change as we move through COVID. At the moment, the sellers have been asking for security, not necessarily getting it, which means that it's even more important for the sellers to do the reverse DD on the buyer.
Yeah, that makes real sense. I mean, if it's going to come back to sort of a question, really, because earnouts are complex, but so a question for you both, really. COVID has just added to an already complex environment. Yeah, Emma, you've now got permission to put your video on. I finally worked out how to do it. So every business is a technology business, and even us M&A guys have to learn technology. But so no, going back to the question, we are looking at a very complex equation when you're doing mergers and acquisitions, but to a certain extent, particularly with distressed deals, but also with the level of complexity in terms of business models, we need to find ways to simplify M&A, because our own house view is it can be part of the equation in terms of increasing productivity within the economy. So, businesses coming together making better businesses. How do we do that? How do we demystify and reduce the complexity so people can be more agile in this equation, particularly as risks have increased? So either one of you.
Well, I'm happy to come in here, Emma.
Yeah.
I think for me, the key things, and this is from a commercial point of view, I think Emma will have more to add from a legal and a drafting standpoint. But commercially is keep the original objectives in mind. And I think all too often we can get drawn into the minutiae of drafting, the wording, sometimes spend way too long on minor points and forget the original intent of the transaction. And I think sometimes it's really key to take a couple of steps back, do a little bit of a reset, and then before you move forward again. And so, keep in mind what is actually important, what you're trying to achieve. I think also buy and sell side need to be collaborative to a certain extent. They need to put themselves in each other's shoes from time to time, and bearing in mind what both sides are trying to achieve. In my experience, deals rarely work where you have a winner and a loser. There needs to be a win-win, or at least both parties need to feel a win-win. Otherwise, the deal tends to fall over.
Yeah, that's interesting what you say, Tim, actually, because I'm working on a deal at the moment. Hopefully we'll complete in the next day or two. And in a sense, it's been quite a nice experience, because the buyer and the seller, they really need this deal to go through quickly because of the economic situation. And all parties, we had a really helpful all parties call at the beginning of the deal, which was only a few weeks ago, where even the lawyers said, let's do this collaboratively. I'm acting for the acquirer. We agreed I wouldn't produce the first draft of the share purchase agreement with a whole bunch of stuff that their lawyer would just take out. Because everyone needs this to go through quickly. It's more important to the client it goes through and they don't spend tons of money on fees than winning every single point. So it's been a really positive experience actually working on a deal like that. So maybe that's one of the good things that will come out of this situation, that it will be a slightly more pragmatic approach to taking deals forward.
So lawyers are going to be nice to each other, Emma.
Well, it was just quite. We've obviously argued over the important bits, but on all this, as you say, as Tim is saying, getting bogged down in the detail. I mean, obviously you take your instructions, and sometimes, the client's brief is, we want to have a very watertight agreement, and we will fight every point. But very clearly here, the priority was, we just need this done. We want to be protected in the main points. Just get it done. But the thing is, though, you need everyone to be bought into that process either, otherwise it just doesn't work.
I think that's right. I mean, I would say that from a negotiation point of view, we always argue that the nice guys win. It's very possible to say no with a smile, but you know, there's too much confrontation in the process, and it's more about open dialogue. You know, if you're not happy, say something. Stop playing the games, and we can deal with it and find solutions. And I think, you know, if we do that with a non-adversarial stance, then you can create more flow. Tim, you were going to comment.
I was going to just throw in a piece of practical advice for people who are in the mix of negotiations, and I think this applies to, you know, the clients, the buyers and sellers, and the professional advisors, and that is negotiate and agree points in English, not in legal documentation. Allow the legal documentation to then protect both parties and what has been agreed, not actually form the negotiation itself.
Very good. I mean, Tim, we've just agreed we're going to do another seminar, I think 23rd of July, on private equity. We've called it the myth versus reality. In this talk, we've been talking about private equity being part of the solution in terms of M&A and M&A activity, but also in terms of investment yield and growing better companies. Do you think sellers are going to be more open? I said they probably will, but you know, they don't like the suits, do they? And that's us included, by the way.
Yeah, no, I think that's true. I think that's a really interesting point. I don't think that's a COVID-specific point. I mean, the number of times I have been acting on behalf of a seller who has started their journey with, you know, I'm selling, it's going to trade, I'm off, I'll hang around for a month and show them where the filing cabinet is, but then I'm off to the beach or whatever it is they intend to do. And then having been through the process, talked to multiple acquirers, very often across the genres of, well, probably not MBO, they would have considered that themselves to start with, but MBI, trade, private equity, even family office. They end up doing a deal with private equity. So they start their journey actually thinking, no, it's not for them. They don't want to be answerable to the numbers guys. You know, they don't want to be living their life with spreadsheets. But when they actually start getting into the dialogue with buyers, in certain circumstances, not all, they find private equity brings something to the party that trade doesn't. And I think for me, the key thing is where you do a trade deal, there may be different agendas, assuming as a seller you are retaining some sort of involvement. Private equity is very, very simple. It wants to buy as a number and then sell for a much bigger number in a given period of time. And that is usually also good for the seller, particularly if they retain some stakes. So you don't tend to have that conflict of agenda in quite the same way. You have a greater alignment. You still have the issues, of course, of culture, and not all private equity is the same. But I would certainly encourage any seller not to rule it out from the beginning. And also bear in mind, private equity comes, I mean, typically, if I break it down into two, you have buyout private equity and you have growth capital private equity. So you can actually do just a straightforward deal and sell to private equity who will then parachute in their own management and possibly promote from within, and so on and so forth.
And Emma, is there a view, are private equity deals more complex or less than trade from a legal perspective, in your experience?
There's pros and cons, to be honest. I know they have the reputation for being more complicated, because you've got especially if the sellers are staying on, because not only are you dealing with the sale of the company, you're also, and actually the thing that the sellers are probably more interested in really is what is their ongoing position. So, what are my share rights? What am I going to get out of the deal when there is an ongoing exit? So you're almost doing two deals in one. So that does add to the complexity. You're also dealing with people who will very often say, you know, we just do deals in this way, not take it or leave it, but you know, so you can only move slightly around the margins and the things are not so negotiable. I actually quite like advising sellers in private equity deals because there's some benefits to doing it. They typically, you know, they will have a decent firm of lawyers on the other side. You do this stuff all the time. They can churn out the documents. They typically get done quite quickly. You they're a bit of a known quantity. You know that they're going to be difficult at certain things, but you know what that's going to be. They're quite clear, they'll draw their boundaries, and as I say, there'll be some negotiation, and there'll be some points that are really important and you have to push those. But actually, sometimes it's much easier in some ways to do that type of deal than to a trade buyer who's never done a deal before, who is possibly using a law firm that they've used, for their property work and their employment work from day dot, but possibly don't do a lot of corporate work. Trying to get those deals over the line can sometimes be more difficult than dealing with quite an aggressive PE house, to be honest.
We've seen, and it's just started again, we've seen inquiries coming back in internationally. I mean, pre-COVID-19, international had been quite strong, particularly with the pound exchange rate. We're probably in a scenario where we are almost deliberately devaluing the pound, and I think within the Brexit backdrop, we'll probably see that trend continuing, and therefore international deals are going to continue. More complex.
Doing an international deal from a legal perspective.
Yeah.
Yes, there will. Yeah, I mean, you've got to agree up front. There's a few key things in the heads of terms. What law is actually applying to this deal is one of them. But assuming you agree it's English law, then there's still complexities. A lot of it is more logistical than even legal. It's just, if you're selling to an American buyer, it's likely that the American buyer will have its usual American lawyers involved, but they'll use either the London office of that US law firm or have to instruct a UK firm. So you're dealing with two lawyers. Sometimes they don't really speak to each other that well. So you're almost negotiating with the UK lawyers and the US lawyers. So it can be quite a disjointed process. So it's not necessarily that the legals are any more complex. It's the process, and also is this sort of culture to doing the deal. So an American buyer.
Yeah. Okay. That's very useful. Thanks for that, sort of, Emma. Tim, just to bounce another question to you. We listened to, we're members of the BVCA, and they were talking about private equity, and then after 2008-9, some of them did change their analysis in terms of valuation because of the the change. What I wanted to look at, and this is as well for trade buyers, I've argued for a long time that the EBITDA model is flawed because it's wholly focused on almost real-time current profits, and actually, for me, the valuation should sit around the speed of growth and the strength of the business model. And we've seen that occasionally. We've seen some multiples going off the scale where you've got fast growth sectors. Do we need to relook at the whole valuation method? Or, we've had a factory reset. Why not have a factory reset on, oh yeah, here we go, yet another EBITDA model?
Should I just give you the very unfortunate truth with that one?
Go on.
It's the only way anybody can compare any statistical information, so I don't think you will ever get rid of it. I think what you do see, and I suspect we will start to see slightly more, is whilst the statistic will still be a price was paid and therefore that is a multiple of X times, and what are you going to multiply? Well, you're going to multiply a profit figure of some description. I think you will see more flexibility on how that profit figure is looked at. I think you might see an increasing range of multiples, and I come back to perhaps scarcity of quality targets, a greater competition. I mean, that was an interesting point in a survey earlier this year. This is pre-COVID, and sorry to come back to private equity, the world doesn't revolve around them, but they are quite a good barometer of deal making. But the key issue that private equity was stating that they felt was a challenge for them currently and going forward was greater competition for quality targets. That I am absolutely sure is going to increase post-COVID-19.
And definitely the case with trade as well, isn't it? I mean,
I think that's also true with trade, but I suspect that the slight difference you're going to have there, so yes, it is true with trade, but unless private equity goes and does something completely different, they still have to make acquisitions. They don't have an alternative.
but you've also got the rise of the trade private equity. So you've got trade companies, platform companies with significant war chests too.
Absolutely, and many trade companies have grown on acquisitive models.
I mean, we did one transaction where they had I think it was over a 200% uplift on EBITDA, having taken in the original private equity investment. So, the model works. Capital can, with a buy and build model, really grow companies. So do you think platform companies are going to be more important again within this equation? Looking at,
I think you can see a couple of things. I think you will see greater diversity. So, I mean, if our statistics, and again, I'm coming back to sellers now, tend to assume they will be bought by somebody doing the same thing as them broadly. And actually, the statistic for our transactions is that's only about 30% of the time. The rest is made up of, might still be trade deals, but slightly more left field cross-sector trade deals. And then obviously private equity and hybrids, MBOs, MBIs, PE-backed MBO leverage buyouts, this sort of stuff. So I think you will get that diversity. With private equity, certainly, private equity needs to platform acquisition to bolt onto. You can't bolt on without the platform acquisition, so they need to go out and find those. I think trade will also look perhaps more at diversification. So where a trade buyer may not be able to bolt on a particular discipline to its existing operations, similar principle. If it then makes a platform acquisition in a slightly different space, it is able to continue to grow by acquisition, which might have been more difficult in its legacy operations. So yes, I think that is the case. I equally think what you may find is what typically would be deemed a suitable size for platform acquisitions, and traditionally I'd say 2 million EBITDA upwards, for some private equity 5+ upwards. We are having a lot of conversations with PE particularly saying, hey, we've revised our acquisition criteria. We are now prepared to look at a lower level than we would have done previously.
That's really useful. I think looking at lower levels, I think we also see a rise of, and we've already been seeing that trend, big corporates buying the more agile, smaller companies to change their business model, but at lower risk than buying, large companies. So in the sub, 50 million pound space, you will see PLCs operating. We've already been seeing that trend, whereas historically they've always regarded themselves as, kind of too posh to go into that arena. I think, increasingly they're valuing teams and know-how. And recognising that they can be lower risk transactions. Emma, we're just sort of getting near to drawing to a close, but really a really quick question. We've got another one of these in a couple of weeks on valuations. We've also got one on the specifics of private equity. The quick question, specific of civil loans. Have you been through the terms and conditions on any? Are they going to have anything that's going to impact on the deal? Certainly, they're going to impact on debt-free, cash-frees, but anything else that they're going to do?
Yeah, I mean, I've seen a few. Obviously, it's taken time for the process, for people to actually get these loans, which is why the little bounce back ones were introduced, because they're quicker to get hold of. But I've now seen a couple from clients. As regards one of my clients who signed up to them, I think it will potentially impact on their onward sale, because the bank have managed to squeeze in some terms to do with the functioning of their business, which is more restrictive than you'd ideally like. So if that financing was to stay there when they sell the company, it certainly will make them more restricted in what they can do in a couple of quite key ways. So for that particular client, then yes, I think probably we need to see more come across our desk until we really sort of have a true picture. Because actually, by total coincidence, the ones I've seen have both been from the same bank. So I think we probably just need a bit more information about them, really, to take a view on it.
I agree. It's every bank's been tackling it differently, haven't they? So we will need to look at that. Guys, we've done our 50 minutes. as M&A practitioners, we would love to talk about it all day. You know, we live and breathe this stuff. So the offer's there to any of our attendees that you've got our email addresses if you want to ask any more questions. We've had quite a few questions we haven't been able to address. So what we will do is we will put out both a recording, copies of the slides, and also we will push forward on some frequently asked questions. We will respond that out to you all. We've been doing probably one of these every 2 weeks now as a webinar. We know the world is webinared out. Having said that, we feel that, you know, an educative chew the fat stance is important, as it's such a technical arena. So we're going to keep going, and hopefully you'll join us with some of the other ones that we've got coming up. You can see the dates on the slides. We'd also, you know, we've been doing a lot of these, so do look at the historic ones. But if you've got any specific suggestions where you'd like us to go deeper or feel that we can add value, do fire them in, and we'll look at putting that webinar forward. It's called the Lead Ahead series. Every week we're also putting posts on our LinkedIn and email out, really with a thought piece on what we see the trends going on. You know, we've got our management consultancy practice and our M&A practice. So, you know, we're quite well engaged in seeing what clients are actually doing with a lot of feet on the ground. And we like to think we can share that in a practical way. So hopefully these have been useful. All feedback welcome. I hope you've enjoyed it, but we'll get that email out with the circulation in the next 2 or 3 days. And thank you all for listening, and we'll catch you at the next one. Much appreciated. Cheers. Thank you. Oh, Emma's there. Look, you get to see her at the end. Cheers, guys. Bye.
Thank you very much.